Hello everyone, good evening and welcome to another in-person FOF. Today we have Yash, who is not a debut to FOF, but he's spoken on Zoom, but in physical meeting he's, I think, debuting for the first time. So please welcome Yashodhan Nerurkar. He's an analyst in our team. And, and Yash tracks non-lending financial services companies, which are fee-based businesses. And it's an interesting presentation on broking industry today. So Yash, over to you.
Hey, thanks, Ronak. So as Ronak said, I mean, this is my second presentation, and last time when I got the chance, unfortunately, I had to do it virtually. So I'm really glad that isn't the case this time. Good evening, everyone, and today I'll be talking about the broking industry, especially the evolution of it. So this industry has had kind of a really good transformation, all the way from a full service brokerage industry to a mix of both the, discount broking and uh, the full service brokerages. So, I mean, some of you might be fortunate enough to have witnessed the early days of this industry, seen the early days in the ring as well. And from there, we have come a long way as such. So, this industry has, in the past decade at least, it has had a kind of a radical change in the last few years and this particular decade. So it's no longer restricted to just the professional traders sitting in front of their computer screens and buying and selling securities. So that mantle has been passed on to the retail investors as well, especially and the masses. So the kind of technology that we have today, I mean, it's kind of possible for some investor who's sitting in a far-flung location to seamlessly buy and sell securities, and irrespective of his geographical location. So the kind of tools and options that we have available today at our disposal, these were kind of unthinkable back in 17th, 18th century. Uh, as opposed to what we have seen in say 10 years, 15 years back, the brokerages now they focus more on the customer service, customer retention, the technology, what they can bring to the table, and also they are not focusing much on the fees. We have seen how the fees have starting to come down. So an analyst in US has rightly commented on the Robinhood and GameStop thing, what happened. So he has rightly commented saying that trading has become a commodity and there has been a race to zero in the retail space. So this is quite true in the Indian context as well, where we have seen over the past decade, starting with upstocks and then Zerodha coming into the market, how the commissions have started to come down, and the benefit is ultimately passed on to the retail space particularly. So this is a very old image. I mean, it's a bird's eye view of Horniman Circle. So here you can see the Asiatic Library, the place where I've circled and where the arrow points. These are basically the brokers gathered in the very early days. So they used to gather under the banyan trees, and that's where most of the trades where they used to happen. So Indian broking industry has its roots in the Horniman Circle under the banyan trees. So this is where it all began, under the banyan tree, and as such, the records of early security dealings in this Indian industry are very meager and obscure. However, there are records of East India companies dealings in the Indian securities market as early in the 19th century. So basically, Bombay port had become a major hub for the East India Company, and along with that, the businesses started to grow in this region. So the businesses which mainly grew were cotton, textile, banking, real estate, etc. So naturally, along with the growing businesses, the business of trading of securities, loans of these companies also started to increase. So back in those days, there were no communication devices where the brokers would just communicate with somebody over the phone or something. So they used to put out notices and bulletins out there. The interested parties would just see the notices and they would inform the brokers, and the brokers here, they would meet under the banyan trees and they would interact and they would trade. So initially it started off with around 6 brokers by around 1830, and slowly this number started to grow. So over the period of time, this number of 6 brokers, it started to grow over time, and it became almost 60. So to accommodate the increasing number of interested brokers, they had to move to a different location. So a similar kind of phenomenon played out in UK as well, where the brokers earlier used to meet at the Royal Exchange, As the congregation started to grow larger, they had to shift their venue and they moved to some coffee house, particularly the Jonathan's Coffee House. So that place today is in its current form is the London Stock Exchange. So after the Civil War, American Civil War, there was this sudden demand for cotton from India. So the cotton businesses grew, and along with legitimate wants of making investments, there was this excessive speculation which was happening in the market. So trades would be carried out from say 9 a.m. in the morning to 7 p.m. And this business was mainly unorganized. People had started investing their time and money with the false hope of making quick money in the stock market, and even the brokers took advantage of this. So the brokers, I mean, whatever prices their investors would give them, ultimately they wouldn't trade at those prices. They used to trade at whatever prices were profitable to them. So this business was, there was some unethical practices which were happening, and there was this need to streamline the business, create some sort of a regulatory framework. So rules had to be laid and to control the malpractices. And all the brokers, they decided to, under the guidance of Shri Roychand Premchand, so basically he was considered as a Napoleon of finance. So he had monopolized the stockbroking business back in 1850s, and everybody would, listen to his advices and, take his guidance. So under his leadership, these brokers, they formed the Native Share and Stock Brokers Association in Bombay in 1875. And that today is the Bombay Stock Exchange. So the share brokers in India, they are governed by the Securities and Exchange Board of India Act, and they have to be registered with SEBI. So unlike US, where so basically the exchanges, they provide a ecosystem, kind of a marketplace via the brokers to the investors to invest. So the brokers have to be acquire memberships of these exchanges. And since in India we have a system where the demat account, I mean the demats and trading accounts are held separately. So they even have to acquire memberships of the depositories like CDS and NSDL. So this is a story dating to pre NSE days where the number of memberships, or the seats were limited, and if an individual had to acquire a membership, he would have to pay a hefty sum or acquire it from an existing member. So at its peak, because there was limited memberships out there or limited seats, the cost of these membership just went up. At its peak, a company named ING Bearings paid close to 4 crores as the membership fee. So thankfully, these costs are pretty much moderated. However, there are plenty of costs which the brokers have to incur at the back end. So they need those physical hardware, they need to lease lines, they need the pricing data from the exchanges. So there are plenty of other costs which they have to incur at the back end. And again, there are too many regulations out there. So even to sort of adapt to these regulatory changes, they have to incur plenty of other costs. So this is a very fantastic interview of Nitin Kamath, the founder and CEO of Zerodha. And as you might be aware, he's quite vocal and he's very active on social media. So in most of his interviews, you'd usually be talking about differences between the Indian and US broking industry. He would be talking about the differences between full service and the traditional brokers. What are the different operational challenges that these brokers have to face? So he's pretty much active, and if you just Google Nitin Kamath interviews, there will be a bunch of interviews which will be out there. So any interview, pick any interview. It's pretty interesting to listen to, from somebody who's an insider, and he just gives fantastic views on it. So let's just rewind the time back a little and just understand how the past 50 years have gone by. So initially, 70s, 80s, even 90s as such, there were no electronic devices the way we have now. Digitalization did not happen the way it has happened now. And basically in those days, everything was based on a paper-based format. Most of the things were done manually. So the thought that immediately comes to our mind is the kind of inefficiencies that must have existed in the system back then. So the kind of inefficiencies, since everything's done on paper-based format, we had those share certificates, which the way we have demat now. So naturally, the paper used to get, the share certificates used to get stolen, lost. There could be forgery, manipulations. So there are many issues which existed back in those days. And again, insider trading by the companies in collusion with the brokers and the market operators also was pretty rampant. So the brokers were, known to front run the big clients or cheat on the rates at which they would execute the orders in the ring. Again, the brokerages were pretty high, unlike what we see today. So brokerages were also high as 1.5, 2%, and many investors who were used to trade from the far-flung locations. Uh, for them, if they had to trade, they had to go through a chain of sub-brokers. So each sub-broker would charge his or her commission, and then at the end, by the time the order reaches Mumbai, I mean, he used to pay commissions as high as 3 or 4%. So there was this period of, after SEBI, was set up around 92. So there was this talk of getting electronic trading systems where the investors would see, the prices of the shares, the bid and ask prices. Also, there was this talk of reducing the entry barriers for the acquiring a membership. So it would be as easy as paying a deposit, clearing an exam, and the moment the broker the member wanted out, the deposit would be returned. So since BSC is basically a congregation of all the brokers coming together, most of the brokers there, they were kind of fearful of the fact that their dominance or the kind of monopoly which they have over the markets, the kind of rates that they charge, that would start going away. So anyway, I mean, NSE went ahead and introduced those systems anyway. So uh, the competition in this field increased as the number of members also or the brokers started to increase. The commission started to come down, and this period also marked the arrival of foreign brokerages in India. So just so that Loka could go, one up above its peer, they started offering other services. So other services, I mean, institutional research, advisory, financial planning, and so on and so forth. So these Indian brokers, domestic brokers, they also faced competition in terms of recruitments of analysts who could, do the research. I mean, the foreign brokerages to pay kind of heavy salaries to the analysts, and there was this competition on that front as well. So all this continued until 2008, until the global financial crisis happened. So in 2008, uh, there was this general gloom in the market. Investors were spooked to go anywhere near the markets. The general activity of client additions by the brokers that reduced. So to induce the clients to come back to the markets, the brokers started to reduce the rates even further. So since there was so much of competition happening, this marked the entry of discount brokers. So in 2011, so since technology was making rounds in the Indian economy, smartphone penetration had started to increase, internet costs were coming down, technology started to get better. So a startup named Upstocks, they had this fascinating idea that they decided to reduce the brokerages, and they made it flat rate per order. And that was the startup discount brokerages. And Zerodha at that same time, they started their business as well. And this business really took off when Zerodha took this decision in 2015 to reduce the equity delivery fees to zero. So since then, the business has just skyrocketed for them. The number of client additions we have seen over the past 7 years, they have been phenomenal. I mean, the numbers are kind of mind-boggling. So there's this very fascinating, interesting book named Bulls, Bears, and Other Beasts, written by Santosh Nair. So this mainly talks about the Indian brokerage industry from the perspective of a fictional character named Lala, who narrates real life incidents as what happened in the Indian broking industry over the years. So it's a very good read. So in the past decade, because of the arrival of discount brokers, this industry has had a transformational change, and there's this race to zero. I mean, can't really say towards zero, but I mean they are moving in that direction. So the discount brokers, at least the top five, I mean top five, I mean one or two would be the traditional brokers as well. So together they have like 57% of the active clients on NSE. So this concept of active clients, I'll just get to it in a bit. So what these discount brokers have done differently is that the kind of onboarding or the account activation of these investors, they have made it really simple and easy. So what otherwise earlier would take kind of a long time, you had to fill those forms manually, the paper based formats. Now it's pretty much very easy to sit at home, conveniently and just open an account on your phone, do the KYC, and the moment you get a confirmation, you can start trading again, and it's a completely hassle-free process. Uh, Again, another thing what they have done is the kind of UI and user experience what these discount brokers bring to the table. That's just totally fascinating. I mean, it's become very simple and very easy for a naive investor to navigate through the app, and all he wants to do is just open the app, click on a particular company share, just put in an order and buy a trade, whatever, buy or sell. So it's become very simple as compared to what the traditional brokers used to do, where their the entire interface was very complicated. If I had to find a particular report, I had to just navigate through the whole screen until I find it will take quite some time. Another interesting thing what they offer is investor education. So we must have seen Zero that has this blog post which they have on their website. So they also provide nudges. So before you enter into any risky trade or some company which is going bankrupt or shares are still trading, so Zerodha might give you a nudge saying that this is the issue with this particular company. Do you really want to do this trade? Or before entering into an FNO trade, they might just warn you about it, about the risk involved. So as the industry is moving towards more of digital tools, they are realizing more of economies of scale. So the incremental cost of processing more orders is kind of remaining flat. So they are realizing more economies of scale, and that's how they can pass the lower cost to the investors. So right now, around 60% of the active clients in the market, they are handled by discount brokerages, and the balance around 40-ish, they are handled by the full service brokers. So again, here you can see clearly in this chart, until 2020, until COVID happened, the growth rate of the client additions were pretty much, moderate. And especially in FY21, that has just skyrocketed. And I mean, it could be said that these are abnormal numbers, might not continue, might continue, but we can clearly see that they are kind of moderating now. So one thing that has really worked in the favor of discount brokers is the kind of discounts that they have to offer, and the lower commissions, because they are appealing more to the retail community. So here you can see right when Zerodha took this decision of reducing the brokerage rates, equity delivery to zero, the growth has just been kind of phenomenal for them. Similarly for Upstocks, I mean, it was traditionally their idea to launch a discount broking platform, but when they went zero in the equity delivery segment, again, their numbers also have just skyrocketed. So the traditional players, what they have done is they have not, entered the discount broking, industry directly, but they compete with the discount brokers by introducing newer plans. So there are light plans, they call it light plans. So the investors who do not want the kind of personalized services, who still want to trade with these brokers, who might have a bank account with them, so they offer these services to them and at a very low cost. So it's pretty much similar to the discount broker, but it's with the traditional brokers, a separate plan. So one thing what they have done differently is, so basically there's a clear distinction between the traditional brokers, the full service brokers versus the discount brokers. So the discount brokers are being very aggressive in terms of the marketing. I mean, the customer acquisition costs are pretty high for them. The reason being, I mean, I'm sure everybody in this room has used Google Pay, and I'm sure most of you all have never been successful in winning a cashback. So, and the only time when you all won something, probably it could be monetary or non-monetary. So the non-monetary could be something like winning, I mean, you scratch the card and you see something like, open account with us, particular DMAT account, and get benefits worth 5,000, or, get 1,000 credited into your account. Or if you are not being active in the market, they might just credit free ETFs worth 20, 30 rupees into your account. So this way, the cost for them, they're literally giving you money to, open an account and stay active in the market. Whereas on the other hand, there are these traditional brokers who take money from you. But just wait a minute and let's just think about what we spoke earlier. So I talked about active clients in the market. So, I mean, we must have seen articles in the news making around saying that Zerodha has overtaken ICICI Securities in terms of the clients what they have, and they are in the pole position in terms of the largest broker. But do we really need to understand who are active clients and why this is a myth? So, and I mean, simply comparing the size of a broking company based on the number of clients, why is it a myth? So active clients are basically those who have traded at least once in the past 12 months. So the moment you open an account, and if you do not trade throughout the next 12 months, you are considered inactive. So we all know that right after COVID, the kind of activity that we have seen in the market, uh, it's bound to happen that the number of accounts, the additions have been phenomenal. And seeing your peer trade, you might have also had that FOMO moment, and you also might have at least done one trade. So for that context, I mean, if you see the number of Zerodha, this is the active share in December 2021. The active share was 18.33%. Fast forward that to 6 months later in May 2021, the number comes down to 17.4. So what we need to understand is that these numbers are very volatile, and you cannot simply rely and know the size of a particular broking company simply based on the active client numbers. So let's just understand the basic difference between the traditional and a discount broker. So traditional brokers are the full service broker, and as the name goes, they offer holistic services. So right from brokerages to portfolio management, wealth advisory, equity research, institutional research, everything they would be providing. Discount broker, and on the other hand, they provide very minimalistic services, and that would include only brokerages and mutual fund distribution service. So their revenues are based on percentage of the securities value traded. So it could range from say 0.25% to 0.75%. And as against, if you compare that with a discount broker, mostly it's a flat fee per order or a percentage of the securities value traded, which is very, very minimal. So the full service brokers are basically appealing to those who want more of a personalized service. They want a personalized touch. They are more committed and active in the markets. They trade in larger volumes, who can bring larger volumes to the table. So these are, the traditional brokers, appeal to those. On the other hand, discount brokers, particularly if you see the average age of participants or the investors on this platform, it's coming down. So it ideally would be around 25 to 30 on the average age. So these are basically those investors who are trading in the markets for the first time, who are new to the markets, who wouldn't want to spend too much on brokerages or the fees, who want to try investing for themselves, who just want to try out their hand in investing. So these are these kind of investors, and that's how both these brokers are competing against each other. So if we do not simply rely on the active share, what exactly can we look at? So another thing that we can look at is the revenues and the source of revenues. So if you break down the entire volumes on NSE, it's comprised of FNO market, which is equity derivatives. Around 90% of that comes from equity derivatives. The balance 10% comes from cash segment. Amongst the cash segment itself, around 8 or 9% comes from intraday, and the balance 1 or 2% comes from equity delivery. Now, the interesting part is equity delivery per se, even though the volumes are pretty low, the number of investors belonging to this category is pretty high. So you might expect the volumes to be really high, but the number of participants is very low. So the decision taken by Zerodha to reduce the equity delivery fees in this category, that really worked for them, because maximum number of investors actually happen to fall in this category. So for a discount broker, the major source of revenue are these two: equity derivatives and intraday stock trading. And for a traditional broker, it will be the mix of all three. So how the proportion of or how the level of activity in the market actually depends to be, the revenues keep changing accordingly. So these are generally some numbers for some of these players. So the first four are listed. The balance two, they are still private. So if you see the market cap of ICICI, it's the largest, around 115 billion. Angel One around 115. 5 Paisa is a very small broker. They separated from the IFL group because they wanted a separate entity to carry on with the discount brokerages. These numbers of the CAGR, they look pretty attractive here, because FY 21 and 22, they were kind of abnormal numbers. The revenue just jumped because of the significant client additions, and also because of a low base. So not too much can be extrapolated from these numbers, but the profit margins look pretty attractive for ICICI, for HDFC, and again the valuations also, they are looking attractive. But again, seeing the markets and seeing the cyclical activity, so not much can be talked about that anyway. So the margins for ICICI are phenomenal, and they have been in this business for quite some time, and they know how to operate in through cyclical times as well. So coming to the US brokerage market, so this market has had a similar trajectory in terms of transition from the full service brokers to the discount brokers. So a landmark, you know, moment in the history of US brokerage was the Buttonwood Agreement. So it basically led to the formation of New York Stock Exchange and the Wall Street community. So this agreement was basically signed between 24 stockbrokers and the Wall Street community. So this agreement talked about, and the agreement was basically to foster trust in the method, and all the trades or all the dealings would happen between them, not outside, and at a fixed commission. So this structure was followed by them, and it continued for a long time. And as the community started to grow, again, similar to the way we observed in the case of UK as well as India, they had to move from the button. So button are the trees. So from there, they had to move to coffee shops, similar to the way we observed in UK as well. So similarly, the way we have SEBI here in India, so in US we have SEC, and that was formed after the aftermath of the crash in 1929. So uh, in 1960, particularly after a series of events, it changed the whole securities industry in US. The volumes rose sharply, and the trading activity had jumped. And by around 1965, the trades were somewhere in the region of 5 million trades per day, and that jumped to around 12 million in span of 3 years by 1968. So the only systems available back then were the electronic communications network, which helped display the bid and ask prices. And not many brokers could implement those systems back then because of the higher costs involved. And those brokers who couldn't basically implement these systems, they also couldn't handle the rising loads, of the trade. So because of that reason, some of the brokers had to shut shops. uh, by around 1975, SEC felt that because of the fixed commission structures, that was sort of creating an impediment and deterring more of public participation into the markets. So finally, they had to deregulate the fixed commission structure, and that led to the entry of several online brokers such as Charles Schwab, TD Ameritrade, and several others. Uh, Especially after that, the public participation simply just jumped, and by around 1985, Trade Plus was one of the first broker to set up online trading platform. By 1991, their co-founder William Porter, he established another subsidiary called E-Star Trade, and this particular company is one of the largest discount broker in US today. So, the last decade in US has somewhat been similar to the way it has been in India. So, in 2015, as you all aware, Robinhood introduced the free trading and investing platform where the brokerages were zero. Uh, so, that because of that decision, a broker named Interactive Brokers, even they decided to follow suit. In 2019, even they took this decision to reduce their rates to zero, the commissions. That followed by Charles Schwab, and then everybody else started to reduce their commissions as well. And around the same time, what happened was some of the players couldn't, because they did not have the financials to pass on the lower cost to the investors. So this also sparked a way of consolidation. So now Charles Schwab has announced a consolidation with Eastar Trade and TD Ameritrade, and Morgan Stanley is acquiring Eastar Trade. So here are numbers of several discount brokers across the globe. So Charles Schwab is one of the largest with an AUM of around $3,700 billion. Interactive Brokers is another large player. The AUM is small, but they are doing a fantastic job. So basically, what they have done is, so their founder Thomas Peterfee, he's from he has a Hungarian background. He had gone to US, and there basically he set up an automated sort of a broking system where most of the functions are automated. They hire only techies and engineers and software people in their company. So because everything is almost automated, they have a lot of cost savings, and the operating leverage is pretty high for them. So for that reason, they are able to pass on the lower cost to the investors. And so Futu Holdings and UP Fintech Holdings, these are two Chinese players which have recently come in the markets. And again, if you see their revenues per client and everything, it's pretty small, and they have a lot of catching up to do. And IG Group Holdings is a player in UK. So if you see this chart as well, I mean, what I talked about in the previous slide, that interactive brokers can manage to pass on the lower cost to the investors. It is pretty much visible from this slide as well. These are the US margin loan rates comparison. So if you see the loan rates for different slabs are the lowest amongst all. Even against Charles Schwab, this is the lowest what they can offer. And in spite of this, they can still make so much of money, and the margins are also pretty good. So this is a very wonderful book named Automate This written by Christopher Steiner. So in his book, he has captured most of the life of Thomas Peter Fee and how he started this business, Interactive Brokers. And it takes you through how, and how and why they can be the lowest cost broker, how have they implemented the automated systems, and how are they still functioning like this, and why can they pass on the lower cost to the brokers. Everything is mentioned quite nicely in this book. So if you can see the revenues, so on the left hand side, I put Charles Schwab and Interactive Brokers, and on the right hand side, it's UP Fintech Holdings, IG Group Holdings, and Futu Holdings. So, I mean, the revenues of Charles Schwab look phenomenally good. That is because also, I mean, some part of their wealth management revenues also included in this. But still, in spite of that, they are still way ahead. And after the acquisition of TD Ameritrade, I mean, they would be the largest broker over there. Interactive brokers, they are in that niche segment and they are doing their job pretty well, and they are earning decent amount of revenues and profits. And the other brokers, they had just started several years back, and they're pretty small, and they have a lot of catching up to do as such. So what Robinhood has able to do and what they have started is something called as gamification of investing. So this is a snapshot of their website. So if you can see, they clearly say that they appeal to a new generation of investors, and the new generation being millennials or the Gen Z population with the age group of say 25, 30 or even lower. So their entire platform and their interface is so much game like how do you swipe on Tinder, just left, right, and whatever you can do. So you can do the same here and just uh, place an order. So this is the interface. I mean, it's just simple as entering the number kind of shares you want, amount, and just place a trade, and it's that's simple. I mean, who would have even thought that any broker could just make it so simple and just like playing a game. They even have mock trading systems. So for that matter, even interactive brokers, what they have introduced is something, a gambling feature on the platform. This is basically to get investors used to the experience of investing, so that later they can take similar amount of risk in the investing field as well. So there's a very interesting documentary called Gaming Wall Street. It's a 2-episode documentary. The first episode basically takes you through the GameStop and the Robinhood issue, and the second part is about the shorting market in US. And it's a very very fascinating show, narrated by the guy from Succession, Kalkin guy. So we already talked about why not to depend on just the active share of these brokers and to consider revenues as well. So here's a fantastic example of why we should look at other sources of revenues as well. So since these brokers, they operate in a cyclical industry, it is very much needed that they withstand this cyclicality in the industry. So these are numbers, these are revenue numbers from just the broking segment of this. So if you see ICICI, it has the lowest at around 45.2%. So most of the revenues, the balance 55% comes from other sources such as wealth management or distribution of mutual funds, insurance policies, and plenty of other sources. So at least the cyclical element is very low, and even if they go through a downturn where the client additions drop, there are not the investors are not willing to trade much, in markets like these. So at least dependence on other sources of revenues come very handy. So if you see something like 5paisa or Angel One, their dependence on broking revenues is pretty high and north of 80%. Another thing what we can consider is the cost to income ratio. I mean, I mentioned earlier that some of these discount brokers, they are spending way too much on customer acquisition costs, and it nearly takes say a year or more, closer to 2 years, for them to break even with a single client. And this is not the case with the traditional brokers. I mean, it breaks even, I think, in 6 months to 1 year. So for these clients, I mean, the numbers, they are operating on very paper thin margins as such, the discount brokers. So ICICI, HDFC, I mean, their cost to income ratios are pretty, good enough. So the question is, who is exactly winning the race to zero, and is zero commissions kind of possible in India? So the answer is no. That is because there's a difference between the US and the Indian industry. That difference comes from three elements. Indian broking companies, because of the regulations, they don't have access to three additional sources of revenues. The first being, in India, the stockbrokers have to return the cash back to the investors every quarter. I mean, on a quarterly basis, which isn't the case in US. They have access to the client's idle cash. They can invest it. They can earn some notional interest on it, and at least whenever the client demands the money back, they have to return it. So from that aspect, if you consider Indian, because of the regulations, our markets are much safer than theirs. So they have access to this revenue, which whereas we don't. Secondly, the is also because of the structure of a depository system here in India. uh, our securities are held in a demat account with the depositories. The broker does not have access to those. Whereas in US, the securities are held in the street name, that is with the broker. If they wish to, they can lend the securities and earn securities lending income on that. And the third being, there's a term called payment for order flow. So the brokers, basically, they are not only acting as agents of the investors, they're also acting as dealers. So they can pass on the trades that are generated on the platform, they can pass it on to some other player, such as a market maker, hedge fund, high frequency traders, and they can earn income on that. So I mean, this practice, especially after Robinhood, they, the GameStop thing happened. So SEC was coming down on them heavily because they considered this as a conflict of interest. Because on one end, you have to guarantee best execution rates to the investor. On the other hand, you are earning money by passing on the trades to somebody else. So, I mean, there was this debate that SEC wanted to ban the payment for order flows, but it's still, the decision has yet not been taken. The reason being, in this particular system, there are multiple players in the value chain. If you take away the revenues of one, it might affect the revenues of other players as well. So you can't really do that, and SEC still hasn't taken any action on that. So that these are three reasons why the Indian brokers cannot push their commissions any lower, and they still cannot operate at such margins. So the margins are so low, and it's like they cannot go any further. I mean, they literally don't have money to cut any more further commissions. So, as I was saying, US brokers, they have dependence on other sources of revenues coming from other sources as well. So these are several brokers operating in US. So if you see Charles Schwab, so the spread revenues are basically the payment for order flow revenues. So these numbers are pretty high for these players, and unlike the transactional revenues, which are basically the broking revenues, they are pretty low as compared to the other segments. So as I was saying, that these brokers, they pass on their trades, whatever they are generating from their clients, and they pass it on to a third players. So these are the other players who pay to these brokers to take the trades. So Citadel is one of the largest player who has a tie with Robinhood. So it's clearly mentioned in the documentary which I mentioned earlier, Gaming Wall Street. So how exactly they took advantage of that, how are they generating their revenues, everything is mentioned quite clearly. So especially after the COVID, this thing, you can see the volume shooting up, right? I mean, going through the roof. So ultimately, what is the narrative, and what will the next, say, decade or something look like? So we already answered the question of race to zero. That's kind of not possible. The only thing what these brokers can do is uh, be competitive, introduce newer plans, try to offer the kind of services, the tech that the discount brokers bring to the table. And so SEBI, by the way, turned 30 years in April in April, and the number of changes that they have introduced in the past 3 years, if you combine that with, I mean, the kind of number of changes in the past 3 years, they have been much more than a combined total of in the preceding 27 years. So the kind of compliance that the smaller brokers have to do, it's kind of painful for them, and because of which the smaller ones are finding it very difficult to survive, because the operational costs are going up for them. The client activity is going on to the either the larger players or the discount brokers. So this would kind of spark a wave of consolidation in the market. So as I said, you need, I mean, every broker, be it a discount broker or a traditional broker, they need that sort of diversification in terms of revenues, uh, because you need to have a certain line of revenues open even during cyclical downturns. So the kind of aggressive marketing we must have seen, in terms of acquiring the clients, this is not sustainable, and they cannot continue doing this because they're hurting their own margins. Uh, clients ultimately not going to be loyal. They'll move on to whichever client is offering the best rates, best solutions, best technology, everything. So they might just switch over to that particular broker. And these brokers are basically appealing to the millennials and Gen Z. So this is a generation that grew up with instant messaging, video chats, online banking, everything, digital. So they demand instant access to information, and they are discounting the importance of physical relationship. So these discount brokers are particularly more appealing to the millennials and Gen Z population, and we are seeing the age, coming down. So as the age group, these brokers are more appealing to this particular age group. What happens remains to be seen, and it cannot be sort of predicted this early. So we just have to wait and watch, and we have to see how it unfolds, because even the traditional brokers, they are being competitive by introducing light plans. They are doing their best to sort of be competitive. So, in a cutthroat world of discount brokerage, as in American football, the best defense is good offense. So, ultimately, the traditional brokers, they might have to take a decision to just go all into an offense mode. They might have to be competitive. They might have to reduce their brokerages, offer plans, and try to get as many customers as possible and continue the activity. Thank you.
Yeah, hi.
Hi.
So a slightly different take on the race to zero. So while you were saying that this zero brokerage is not sustainable, if that were the case, then Zerodha and even Angel, for that matter, would not have been as successful as they are, right? I mean, Zerodha today is sitting on around 4,300 crore revenue.
Right.
It's around 1,800 crore PAT. And same with Angel, which is about 2,300 odd crores with a 30-35% net profit
Correct.
margin. And they've grown exponentially. So they've grown like at a CAGR of 60-65% year on year
Yes.
for the last 3 years. So if that were the case, then kind of they would not be as successful as they are, right? So
Correct.
what's your take on this?
So basically, when we talk about zero commissions, so basically there are two parts to it. One is zero commissions across all segments. So here, as I talked about earlier, there are different segments like FNO, there's intraday, there's equity delivery. So the commissions what they have reduced is specifically just for the equity delivery segment. Intraday and FNO segment, they're still making that money. Besides, they have those margin loans given to the investors. Margin trading happens, so they're earning money out from that aspect as well. So the revenue sources, as long as you keep adding more clients by doing heavy aggressive marketing, these costs will sort of continue. The foreign brokers, on the other hand, they have slashed the rates across all segments. And that, say for instance, interactive brokers, so zero commissions are only for the people who are trading in US securities and belong to the US market. Other markets are still earning some revenues from it. So, and they have other sources of revenues which I talked about earlier, like payment for order flows, securities lending income. They are earning notional interest, which is still continuing. For Indian brokers, that's not the scope. So, as long as so in the past 2 years, you said they have grown at so and so CAGR. That is because in the past 2 years, you have seen heightened level of activity in the markets. If that were to slow down, the sources of revenue would dry up. So for that reason, they have to be dependent on other sources of revenue, such as distribution of mutual funds. So at that point of time, it remains to be seen how do they perform in those market conditions.
I was just going through some data which kind of showed that even in market downturns, the FNO activity continues to be robust. So would you still call this a cyclical industry, as a lot of people think it is?
So now what has happened is even the retail sector to some extent has started to participate in the FNO segment. That's why Zerodha had to introduce the nudge thing where they warn investors that this might be sort of risky for you. Do you really want to go ahead with the trade? I think SEBI also came out with certain circular of there are certain guidelines of investing or to reduce the activity of FNO market. So the moment investors start panicking, I mean, retail investors are very finicky in terms of how much risk to take. If they incur even a slight amount of loss, they might want to go back to the personalized services such as traditional brokerage, or they might want to continue with mutual funds. So that's I mean, in the past 2 years again that we have gone through 2-3 cycles. So that concept buy the dip, right after before COVID, Bitcoin was the craze. most of the people in the Gen Z category, they were saying buy the dip, and that they associated with the stock market as well. Saw the peers making money out of it, and they also won't get into it. FNO was one part where they thought they could. I mean, in 1 or 2 years, the activity seemed good, but now when markets also looking really difficult, the volatility has died down, then options wouldn't make sense in those scenarios.
So you do think that it's cyclical, this industry?
Industry is cyclical. How the revenues will pan out, and if Angel One or some discount broker, if they can introduce certain other segments where they can make money out of it, they might do good again. So it can't be said that either it's the era of discount brokers or it's the era of full service brokers which will continue. It could be either the two. It could be a mix. The top brokers could stay and the discount brokers could continue.
And this race to zero that you were referring to, was that in reference to American brokers or was that for Indian brokers?
So American brokers have already gone to zero. So Indian brokers, they have gone to zero in certain segments. That too, discount brokers have gone in equity delivery. So for instance, now Kotak Securities, where other people have reduced the brokerage rates on equity delivery to zero, they have done it for intraday category, and for equity delivery, they charge 0.25%. So every broker is earning money differently. So some have gone to zero in equity delivery, some haven't. So this is how it is.
So all in all, you're saying that it's slightly difficult to kind of categorize what the future will be in terms of
It'll be difficult because ultimately revenues depend on multiple sources. Now, how and if they simply go to zero, they are killing one of the major sources of revenues for them. So it's very difficult to quantify and pinpoint that this is who's going to stay.
Sure. Thanks.
Hi. So I have a small question regarding the valuations.
Okay.
So do you have any idea as to how the brokers in the US are trading? So in India, ISEC is trading at 5x to 7x.
So during COVID times, they were trading at slightly higher valuations. I don't have much idea about what they're trading at right now. I can get back to you, but I think they are slightly more expensive because their the business is already stabilized. They still have, so basically there were 1 or 2 hits on the revenues about the payment for order flows when that worry was there. Now I think that worry is also behind them, so I think they're still continuing at a decent valuations.
Hi.
Hi.
Hi. Thanks, Yash, for the presentation. You did talk about over last 30, 40 years how broking has shifted from in-person to digital or DIY or it can be virtual. Same thing also seems to be playing out on the wealth part, which is the main source of income right now, which is left with a broker, be it Indian or US.
Right.
But wealth or insurance also seems to be a high touch point where you have a relationship manager who kind of figures things out for you and advises. But for a new investor who comes in, that wouldn't be feasible to have a relationship manager because of the wealth that that person might have.
Correct.
So how is that part of tech playing out in terms of?
So again, there are two sides over there as well, right? I mean, there's regular as well as there's direct, and plus there are wealth managers who are handling the entire portfolio. Now, for those who belong to the HNI, ultra HNI category, for them it's much more beneficial to have somebody take care of their entire portfolio rather than you focusing your entire attention on that because you have other activities to do. For the regular investor, I mean, 1 or 2 times they might try, investing themselves, but seeing the volatility in the markets, even they might panic after a point of time. So some might continue, some might get advice from their own peers, but some of the people who are actually losing a lot of money after investing, they might panic and they might refer to. So again, this is another industry which will continue side by side. I mean, you can't just say it's either regular or direct. It'll be a mix of both.
But do you see application of technology here and kind of commoditizing this or maybe some predefined?
So there are robo advisors handling say a segment below the HNIs, mass affluent or something. So there are tools being developed to handle this category as well. So far it hasn't sort of gone away with it. I mean, it's still at a very nascent stage. It's still happening at its own pace. So haven't heard or seen anybody any player doing in a major scale. So we need to see how it sort of unfolds.
Great. Thanks.
So it was a good presentation.
Thank
I
you.
fully agree with you. that race to zero is not possible in India.
Correct.
I was a broker 2 years back. Now I got merged with somebody else.
Okay.
Problem with the traditional broker is, now if I reduce the brokerage for my friend, he will come and say Zerodha is charging me 20 rupees, you charge me 20 rupees. Currently he is giving me 100 rupees. I take direct hit on my bottom line.
Correct.
You know, that is the reason why 5 Paisa became a separate company from IIFL.
Because they're taking the hit.
Because there was this pressure, and because they are so big, they have flexibility of creating another broking company within broking company and shift. So because I know somebody who was handling their KYC, most of the 5 Paisa clients are IIFL clients only.
Correct.
But they will conveniently show it as a new client acquired, but it is not new client acquired.
True.
Zerodha also, I have studied it. So they have, because why their margins are good is because they have all this very small option traders.
Right.
Okay. And generally when I go to trade, I will always think I will trade 5 lots. But eventually I will trade only 1 lot.
Correct.
Because either I don't have a guts or market is not in my favor.
True.
So initially Zerodha earned most of the money out of float. Even today, they can use that money for 3 months. HDFC give them special rates even on current account.
Correct.
So, now due to this COVID and even my own cousins or my niece or nephews, they don't trade through me and they go to Zerodha.
Correct.
And if you ask him, they'll say, Kaka, શું છે? એકદમ easy છે. Easy છે. They never ask me whether do you have a similar thing. Then I don't even have a chance to tell them that I can also offer you similar thing.
Correct.
Problem is also with channel partners. Because the moment a client comes to them, Zerodha 20 paisa charge करे, 20 रुपया charge करे, तू कर. He doesn't have a guts to say, yes, I will also charge you that, but you should never call me.
Correct.
This is my online platform. Trade on it. If you have any problem, whether you want ledger balance, you want your IT global report, or even a smallest thing, you will have to call centers. They will say, thank you very much, sir. We appreciate, sir. And they will keep appreciating, but will not give service. So I tell those channel partners also that by picking up their phone and updating them every half an hour about their portfolio value is also a service, and that is why you are charging that.
Correct.
That you need to explain it to your customers, and yet if they want to go there or you want to retain them, you offer them the same scheme, but don't talk to them.
True.
The problem is that they keep talking to that customer and still charge them a Zerodha fee. And that is why they are into loss.
Correct. Absolutely true.
So, race to zero is going to be very difficult. Tomorrow, there are seasons. So, I think we are all in the market for many years.
True.
So, there was a season of Vaida, then there was a season of margin funding. Now, there is a season of option trading. 90% of the Zerodha kind of customers, they don't even understand option. They just trade. And what you said, this investor education is all cock and a bull story. There is no education. I am sorry to say that. They don't educate.
Correct.
They don't educate. And it's a fact. They educate, yes. They keep giving that slide. But they don't actually seriously go and address to them. See, I used to tell my customer that if I go to same taxi every day to Fountain, taxi wala will open the door, मुझे बिठाएगा, पानी की बोतल देगा. उस जमाने में पानी water bottle used to be cost, was a novelty. He used to give us that also. But if you are not a regular customer, वो तुम्हारे मुंह बिगाड़ेगा. If broker आपसे मुंह बिगाड़ता है, that means you are earning, he is not earning.
Correct.
But people don't understand that. People want broker to smile.
True.
So Zerodha and all are smiling. So I agree with your point that only future can tell. If the revenue from option will come down and more people are losing money in options because they don't realize its time value of money.
True.
So either they will keep blindly writing the option or they will keep buying the option.
Correct.
So additional revenue even for zero die is a must. And I am very sure Nitin Kamath is very smart. You will realize that.
Yeah.
Hi, thanks
Hi.
for the opportunity and great presentation.
Thanks.
Congratulations on that. Just one question on you spoke a little about the way ahead, consolidation as a real possibility. Do you think that within these new age fintech brokers, consolidation will become? I mean, it will come sooner than it would probably come to the traditional brokers because I mean, sure, technology is helping with respect to economies of scale and incremental cost of uh, revenue is going down. But like for instance, if you see these days, you see those ads coming on TV that Byju's
Yeah.
is having its tuition centers, which like if you think of it, it's an ironical thing that they started out as a online coaching center and now they're getting into physical presence. So something like that, do you think that could happen going forward to these discount brokers? Because like how far can they
Yeah.
really
So right now for the discount brokers, it's like running on a treadmill. You can keep running as long as whatever you're doing, the acquisition cost that you are actually spending on them. I mean, if the client keeps on adding, it's generating some sort of revenue for them. Yeah, as even Mr. said, the moment this all stops, the music stops, that's when the real numbers and everything will start coming out. So at that point of time, the brokers whose financials are strong enough because they have diversified, they have provided other they provided themselves other source of revenues as well. So for them, it might be not feasible to go on a consolidation. I mean, they might acquire the ones who might be at the edge of their sort of revenue game. So nobody has said anything about acquisition in the discount broking space as well. But like I said, I mean, nothing can be predicted at this point of time because since the discount brokers have started to come up, there's more aggression happening. So even in the conference calls, most of these brokers have admitted that the kind of spends they were doing, it was aggressive and it crossed a particular point. Now they have to tone it down. So after toning it down, the number of additions, how it happens, how the revenues flow, who comes up on top, because active share again, keeps on changing on a monthly basis. So at that point of time, how the financials sort of compare between different brokers at that, I mean, we could tell something about the consolidation at that point of time itself. So nothing can be ruled out. I mean, if they have an opportunity, they have, because most of these brokers, they might not even have the cash backing. I mean, some of them are listed. At least the unlisted players, they still might. So zero is still bootstrap. Other players, if they can access funding, they might go on acquisition spree as well. Like we have seen, similar to Byju's or what they have done in the market. So, I mean, nothing can be said at this point of time as such about acquisitions.
Okay, thank you.
So I'm really sorry, but after having said that, I recollected a conversation between me and Jaideep Arora of Sher Khan when he set up ICICI Direct. He came to me and asked me, okay, Samir, if somebody is giving you 10,000 rupees a year revenue, what kind of revenue you consider this as a good revenue or a bad revenue? So I told him even 10,000 rupees a month revenue, I don't consider it a big revenue. And I laughed at him. But I think all the brokers like me have actually, lagged behind because they went only for those kind of revenue where they don't service them. And we always thought that अगर अपने को इतना सर्विस करना है तो 10,000 रुपया साल का देगा वो क्लाइंट अपने को नहीं चाहिए. Not नहीं चाहिए, but it is not significant client for us.
Correct.
And that was, I think, the biggest mistake that all the traditional broker or new broker who started a traditional broking made a mistake.
Right.
You don't service them, no. So whether they give you 500 rupees. So he gave me a calculation then, 10,000 into some 10,000 client.
Correct.
So it's true. I mean, they have grown because of that. We missed that. And that is why, they have grown so big.
Correct.
So thank you for a nice presentation.
Thank
So I've got 3 questions come observations. So you might like to throw some light. So one is that the bank owned brokers, the float is actually enjoyed by the banks and they are making money, and
Correct.
that profit from that float is not being counted in the broking subsidiary. Okay, so the banks are very big beneficiary of that float and they can compete really hard with if they want to. And I've been a client of ICICI Direct for last 20 years. In fact, they are not celebrated that much, but they were one of the first to open a online broking company, and much before Zerodha. And I had to become a client because I was going abroad. So to continue trading, I had no choice. I had to go to them and open an account. So that was the observation. So they can be fierce competitors. And I think in terms of profitability, other than Zerodha, I'm very surprised how they are making that much money. But banks are the ICICI Direct and Kotak and HDFC Security, they are making huge amount of money. They are very, very profitable.
Correct.
Right? And they have been reducing their rates. So ICICI Direct used to charge 0.75%. But nowadays they are very happy to give you, if you have even slightest of volume, they have that prime plan, and they can give you 0.1% brokerage very easy. And their FNO fees are also very competitive. So that was one. The second thing is I'm wondering, so you have spoken about competition among broking companies, right? Then there is a competition between broking and mutual funds. So a lot of people are advised, not to trade themselves. They should invest in mutual funds. And then amongst mutual funds also now there is a idea that nobody makes money, so better to invest in index fund. So I'm wondering what will happen to the business of broking.
So, I mean, there are many theories which are floated out there. So, like I said again, like regular direct, people are advised to go either the direct way. So, ultimately, the thing remains that the people who need the personalized services, they will opt for it. And we have seen in other developed markets as well that direct trading into equity doesn't go out of fashion. So even though we have all the fascinating products out there, index funds are catching up, ETFs are catching up, but still, people who want to continue investing, they wouldn't stop. They still might try their luck. The discount brokers, it's become so simple investing, and even with a minimal capital. So I didn't talk about it, but the wallet size of the investors on the discount broking platform is very minimal, like 10, 15,000, 20,000 max. And you might be aware, like people who fall on the traditional brokerage platform, their wallet size is much different. So even with a limited amount of capital, they might still try their luck at investing. If they get successful, they might tell their peers. So this activity to some extent is again zero for the matter. Their acquisition costs are phenomenally low. That is because they entirely depend on referrals. So I may convey about this product to somebody else, and that's how the growth is coming from. They only charge for the account opening fee. Customer acquisition, they don't have a sales team, in fact. So as such, I feel that broking and this will continue. The real question is, say 10, 15 years down the line, active versus passive. So we can talk about it at that point of time again, how that will pan out. But right now, I feel, equity investing it'll continue. So brokerages businesses are here to stay. So who will win, either discount or traditional, or it'll be a mix of both? That needs to be seen as such.
The last one is actually a question. So you mentioned that in US the brokers, there are no custodial services. There are no stock holding corporations.
Correct.
So the brokers themselves hold the stocks. So I found that when I wanted to invest abroad, I found that as a risky thing to.
So it is. So even Nitin Kamal, for the matter, said the same thing, that although we have these regulations implemented in our systems, somebody might think that we are still a step behind them, but at least our markets are much more safer for the investors. We don't have the risk of losing our capital, like you said, the float or money or whatever. We don't have a risk of losing that. So we know that our securities, our funds are going to be safe with the either depository, the broker, and the broker also has to return the funds. The broker has to return the funds within on a quarterly basis. So I mean, it's much safer here in India from that aspect.
So, since Parag Parikh FlexiCap Fund invests a lot of money in US markets, how do PPFAS handle this situation? Any idea?
So I would request Ronak to
So-
answer that.
So it's not entirely true that there is no custodian market. Banks can act as custodians, and there are these clearing banks which are available, very big institutions which are actually managing your custodial accounts under your name. So institutions can have a choice of either putting their money in street name, which is highly unadvisable, but it's better to have a custodian account. Yes. So institutions generally, how we trade in India, we have a custodian broker relationship. The same relationship can be replicated globally, and you can have your custodian manage your account under your own name. So the shares essentially every day tally is given to you that this is what is in your account, and nothing can be lent out if you don't want it.
Hello.
Okay.
So I want to know about the opportunity size of the brokerages in terms of, if you have any idea in terms of
Opportunity size as in the addressable
since,
market.
yeah, in the market.
So most of the reports would state that we are still very small as percentage of the GDP, but I mean, you can't expect every single household to have, I mean, every single PAN card to hold at least one demat account. So we would never catch up to the entire strength of our country, but I mean, there's still a lot of catching up to do. So if you call the addressable size of the entire population of India, it's there. But how many people would actually open, that depends upon how the markets behave, the sort of campaigns that they run. Because here in India, to a certain extent, investing is still seen a bit of risky thing. They might still stick to the traditional assets. So addressable market size could just vary based on how we define it.
And is there any?
But I mean, to answer your question, I mean, there's still scope to grow. So we might be at a very nascent stage. We still have plenty of room, to grow as such.
Okay. And is there any growth triggers from your side? Like, if you can see that what can trigger, like how we got COVID and the numbers.
So at least from my observation, what I have seen is this generation, people below 30, they are at least becoming more bold in terms of equity investing. They want to take the risk, and they are actively trying out, and there's so much of media and investor education out there that you know about a particular product which you wouldn't have known, say, 10-15 years back. Now there's all the information available. There are different blog posts which talk about it. There are influencers which give you some basic idea about how investing would turn out to be. There are different articles which talk about research done by some analyst. So there's so much information out there. Anybody can pick up a report, some article, and just try the luck at investing. So at least this generation, as I see, they are much more open to equity investing.
Thank you.
Great. Thank you.
Thank you.
Thank you, everyone.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes. But when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
right way.
At PPFAS, we think like Rahul and his father. that volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.